Welcome. Thank you so much for coming to watch this deep dive with us today. We're about to tear through one of the densest financial documents released this quarter, and our job is to extract the absolute essentials you need to be informed quickly and thoroughly. Before we jump into the material, please do us a huge favor. We strongly suggest you hit that like button, share this video, and subscribe to the channel right now to stay tuned for all our upcoming content. And if you find these detailed analyses invaluable, please do evaluate our channel membership options. It's really the best way to support the ongoing video production that makes this level of analysis possible. And of course, you can always show your support directly using Super Thanks. So our mission today is to crack open the results for ARM Holdings Plamp. We're looking at the second fiscal quarter ending September 30, 2025. That's Q2 of their fiscal year 2026. We are going to translate their very complex financial filing, specifically their Form 6K and the shareholder letter that goes with it, into plain English. The goal here is to distill everything down to the 5 most critical financial and operational takeaways. We'll give you a high-level briefing on the company that, well, literally designs the future of compute.
And that's really the core narrative coming out of this quarter, isn't it? It's one of accelerating dominance. ARM is no longer just a mobile IP supplier. It's aggressively framing itself as, and this is their phrase, the AI platform powering the future from milliwatts to megawatts.
That phrase really says it all, the scale of it.
It really does. That scale from a tiny smart sensor on the edge all the way up to the largest hyperscale data centers, that's the engine driving this immense financial success right now.
So before we dive into the weeds, what's the headline?
The headline is just continued massive success. This is their third consecutive quarter exceeding $1 billion in total revenue. It's anchored by a huge 34% revenue growth year over year. And what's crucial for you to understand is that this growth, it isn't just volume, it's a strategic shift. They're moving toward higher value, higher margin product sales that are really capturing the AI spending spree we're seeing everywhere.
Okay, let's unpack this with the essential scorecard then. That's what really frames the entire quarter. We always look closely at the non-GAAP figures first because that's what management uses to show the core profitability of the licensing business, excluding some of those non-cash expenses tied to long-term investment. So let's run through the core metrics for Q2 FY2026 non-GAAP. What are we looking at for revenue?
Revenue came in very strong at $1,135 million, or $1.135 billion.
And that's that 34% year-over-year increase you mentioned.
Exactly. A huge jump.
And how'd that filter down to net income?
Net income was also up significantly, $417 million, which is a 32% increase from the same time last year.
Okay, so strong top line, strong bottom line. And for EPS?
The fully diluted earnings per share came in at 39 cents. That's a 30% increase. So you see the theme here. Everything is up around 30% or more.
Right. Consistent, powerful growth. And the margins are always, well, eye-watering with ARM.
Right.
What did we see this quarter?
The non-GAAP gross margin was 98.2%.
98.2. I mean, that's just an astonishing number. It really reinforces the power of that IP licensing model.
It's practically a pure profit on every license before operating costs. And speaking of which, the non-GAAP operating margin was 41.1%, which is up significantly from 38.6% in the prior year period.
Okay, so that's the good news, the non-GAAP story. But we have to address the elephant in the room. When we look at the GAAP figures, the strictly regulated accounting standards, the picture is, well, quite a bit different. GAAP net income was only $238 million,
right,
which gives you an EPS of just 22 cents. That variance is huge. It nearly halves the net income compared to management's preferred metric.
And that difference is in itself one of the most fascinating takeaways from the quarter. If you look at operating income specifically, the variance is just staggering. You have $163 million in GAAP operating income versus $467 million non-GAAP.
Wow. So that's a $300 million difference.
Over $300 million just in operating income. And you, the investor, you have to decide which number you think more accurately reflects the real health of the business.
So where is that gap coming from? What's the main driver?
The primary driver of this massive difference is a $265 million charge for share-based compensation, or SBC.
Okay, SBC. So this isn't cash leaving the bank account today.
Exactly. It's stock or options being granted to employees. But the question is, why is it so high? $265 million in just one quarter. It's a direct reflection of the hyper-competitive global market for engineering talent.
So if we're looking at this critically, that $265 million isn't so much a cost of doing business today as it is an aggressive talent acquisition war chest for tomorrow.
That is the perfect way to put it. ARM is essentially paying a massive premium in non-cash equity to secure the world's best chip architects and AI engineers.
Because if they don't, someone else will.
Precisely. The filing shows that they increased their non-GAAP research and development expense by a dramatic 45% year over year. And that SBC cost is highly concentrated in that R&D function. This investment is entirely focused on designing the next generation of high-value architectures. We're talking ARMv9, the next-gen Neoverse, and the highly integrated compute subsystems.
So management is using that non-GAAP metric to say to investors, look, this is what our operating efficiency would be if we weren't in the middle of this aggressive hiring and investment phase.
Yes, it allows the market to see the underlying profitability of their business model, which, with a nearly 100% gross margin, is fundamentally extremely healthy.
That makes sense from a business optimization standpoint. But let me push back a little. How do we reconcile that aggressive investment strategy with the more conservative outlook implied by the GAAP numbers? Doesn't running an operation that looks significantly less profitable than those strict accounting rules raise any concerns about the actual cost of this growth?
It raises a valid question about sustainability for sure, but it really just reinforces their core strategy.
Yeah.
They are prioritizing market share and technological leadership in AI over short-term GAAP profitability, the calculated bet.
So the logic is, if they didn't pay that premium to secure talent now,
They would lose the AI race, and their future royalty streams would suffer far more than the current GAAP net income is suffering today. They're sacrificing today's reported profits on paper to ensure they own tomorrow's revenue annuity. This is a very aggressive, very long-term strategic bet on remaining the fundamental IP provider for the entire AI infrastructure.
that reframing helps tremendously. Okay, diving back into the revenue breakdown, total revenue clocked in at $1,135 million. And this impressively exceeded the high end of their own guidance, which it topped out at $1.11 billion. So a solid beat.
Very solid beat, and it was driven by both core engines of the business.
Let's start with the first engine, royalty revenue. This is the annuity part of the business, right? The money earned every single time a chip containing ARM IP is shipped.
That's right. It's the long-term recurring stream.
And that hit a record $620 million, which is a robust 21% year-over-year increase. And it's important to stress, this growth wasn't narrow. It was driven by adoption across smartphones, data centers, automotive, and IoT, a very broad base.
And here's where that R&D strategy we just talked about pays off. The documents specifically call out two key drivers for that 21% royalty surge. First, the increased adoption of higher royalty rate technologies, specifically the ARMv9 architecture. And second, the new ARM compute subsystems, or CSS.
So they're not just selling more units, they're selling more valuable units.
Exactly. This demonstrates a successful transition from licensing simple core designs to licensing entire pre-integrated compute platforms, which command a significantly higher price per unit sold.
Could you break that down? How much more valuable are we talking?
Well, think of it this way. If a simple ARM core might earn them a royalty rate of, say, 1 or 2 cents per chip, an advanced ARMv9 architecture with enhanced security and performance, or an entire CSS platform might earn them 4 or 5 cents per chip. The volume is high, but the value they're capturing per chip is increasing even faster. This is the ultimate goal of their R&D spending. Drive higher value, get a higher royalty rate, and fundamentally strengthen that long-term annuity.
Okay, that makes sense. Now, for the second engine, licensing and other revenue, this saw the biggest spike of all. It soared to $515 million, a massive 56% surge year over year.
A huge number.
But that kind of quarterly jump in licensing often leads to questions about sustainability, right? Because licensing can be lumpy.
It is naturally lumpy, and the documents absolutely acknowledge that. They attribute the spike primarily to the inherent fluctuations in the timing and the size of multiple high-value license agreements. The simple fact is they managed to close multiple big deals in this specific quarter, which reflects really strong underlying demand for their cutting-edge IP.
So how do we smooth that out and see the real trend?
To smooth out that lumpiness, we need to look at a key forward indicator they provide, the annualized contract value, or ACV. This metric basically normalizes all their license and other revenue commitments across all the outstanding agreements into a yearly figure.
And what did the ACV do?
The ACV increased 28% year over year to $1.6 billion. That 28% increase signals that the long-term underlying pipeline for future licensing fees and the subsequent royalty streams that will follow remains extremely healthy. So even if the actual cash they receive for licensing fluctuates quarter to quarter, the structural commitment from partners to use ARM's IP is consistently growing.
So ACV is the true signal of that continued future growth. Speaking of the future, what does the guidance for Q3 tell us about their short-term expectations?
The forward-looking guidance for the next quarter is aggressive, and it clearly reaffirms that high investment thesis we discussed with the SBC. They're projecting revenue of $1.225 billion, give or take $50 million.
So continued sequential revenue growth. That's a very strong sign of sustained momentum.
It is. But this next part is absolutely critical. They're guiding non-GAAP operating expense to around $720 million.
720. That's a big jump from
Yep.
the $648 million in Q2.
It's a huge jump. That is a clear, intentional acceleration in spending. And they're guiding non-GAAP fully diluted EPS to 41 cents, plus or minus 4 cents. But that jump in operating expense over $70 million quarter over quarter, it directly correlates with that R&D investment. Management is explicitly signaling that they are prioritizing spending today to solidify their technology lead and drive the adoption of those high-value, high-royalty products tomorrow. They are not waiting for the AI market to settle. They are investing to capture it now.
That planned acceleration in spending brings us perfectly to how they're actually using that capital operationally. The financial results prove they have the money, but the core business success really rests on how they deploy it. And the primary vehicle for that deployment is, of course, research and development.
Exactly. Let's revisit that non-GAAP R&D expense number. It increased a massive 45% year over year to $466 million. To put that in perspective, that's almost $500 million dedicated to R&D in a single quarter. And this huge surge is purely driven by investment in engineering headcount, which, as we noted, is the source of that high SBC.
So this is the cost of staying ahead.
It's the cost of maintaining their technological moat. ARM recognizes that they can't just rely on volume anymore. They have to provide more integrated, higher performing, and differentiated IP. That investment translates directly into the ability to charge higher royalty rates, more value per chip down the line.
And a huge part of this investment strategy is the acceleration of their compute subsystems, or CSS. You could argue this is the most significant strategic shift ARM has made in years.
I think you could.
Instead of selling individual IP blocks, you can think of it like licensing individual Lego bricks. They are now selling pre-integrated, pre-verified systems. They are selling an entire, ready-to-use subsystem, which has to dramatically reduce the complexity and time to market for their partners.
It does. And the market adoption of CSS is accelerating faster than even they projected. They now report 19 total CSS licenses spanning 11 companies. Crucially, in Q2 alone, they signed 3 new CSS licenses. One for smartphones, one for tablets, and significantly, one for the high-value data center market.
And are these designs actually shipping yet?
Yes, and that's the proof in the pudding. 5 customers are already actively shipping CSS-based chips. One of them is already shipping its second generation of CSS-based chips. That speed of adoption speaks volumes about the time-to-market advantage that CSS provides. It lowers the barrier for customers to create these complex system-on-a-chip designs. ARM takes on some of the risky, complex integration work, allowing partners to focus solely on their unique differentiation, like a specialized AI accelerator or custom peripherals.
And they call that a big commercial win
The
range.
huge one. They highlighted their deep collaboration with Samsung for the Exynos family of chipsets. With this deal, the top 4 Android phone vendors globally are now all shipping CSS-powered devices. And the company labels this a significant tailwind for future royalty revenue because these pre-verified packages inherently command that premium, higher per chip royalty rate we talked about earlier.
The success of the CSS model leads us directly to the newest technological platform emerging from all this R&D spending, the Lumex CSS platform.
The report calls this ARM's most advanced smartphone platform to date, and the performance metrics they're citing are genuinely game-changing for mobile AI.
The focus of Lumex is crystal clear. It's all about shifting AI processing from the cloud back down onto the device itself. And the performance gains are striking, especially on the CPU side. It delivers up to 5 times faster AI performance directly on the CPU.
5 times. How are they achieving that? Primarily by leveraging their specialized instructions called Scalable Matrix Extensions, or SME2. And on top of that, it boasts up to 3 times greater energy efficiency compared to the prior generation, so faster and more efficient.
Let's pause on SME2 for a second. For our listeners who might not be deep into chip architecture, what exactly are scalable matrix extensions, and why are they so crucial for that 5x AI speed increase?
That's a great question because it directly translates a very technical feature into a core business capability. AI algorithms, especially neural networks, rely on just massive amounts of matrix multiplication. It's a continuous stream of specialized math operations. Before SME, the general purpose CPU cores handled these calculations, but not very efficiently. SME2 is a specialized instruction set built directly into the core design that allows the CPU to perform these matrix operations much faster and more energy efficiently.
So it's like adding a dedicated math coprocessor right into the CPU core itself.
A perfect analogy, and this is foundational for real-time AI workloads. Things like running the Gemini models or other large language models locally on a phone without draining the battery in an hour.
So the Lumex CSS essentially turns the phone's CPU into a highly capable, localized AI processor. And that enables the kinds of real-world applications we're always hearing about, like real-time, on-device translation, or complex image enhancement, or personalized assistance, all running instantaneously and privately right on the phone.
Exactly. And the ecosystem adoption is already accelerating this, which really speaks to the demand. Leading applications like Google's Gmail and YouTube, along with Alipay, are optimizing their code specifically for on-device inference using this architecture. That's a massive stamp of approval. And key silicon partners like MediaTek are designing chips around Lumex, with flagship smartphones from major players like OPPO and Vivo having launched in calendar Q4 2025.
The time to market there is lightning fast. They launch a new high-end platform, and flagship devices are hitting the market almost immediately.
That turnaround time is exactly what the CSS model promises. And we shouldn't overlook the gaming and graphics component either. Lumex isn't just about AI. It integrates ARM's Mali G1 GPU, which delivers up to twice the AI and graphics performance of the prior generation. This is critical for driving the adoption of high-fidelity mobile gaming. We're talking about enabling demanding games like Fortnite and Genshin Impact to run smoothly on these flagship devices. The success of Lumex CSS, from specialized AI extensions to GPU acceleration, is a perfect illustration of how that $500 million R&D investment translates directly into technology that captures high-margin end markets.
Okay, so we've established that ARM is spending aggressively on the future, and we've seen the success of that strategy at the mobile edge with Lumex. But ARM's story today is much bigger than just smartphones. Let's turn to the core qualitative growth story, demonstrating where ARM's technology is winning across the entire spectrum of compute needs.
This is where the scale of ARM's transformation truly becomes clear. We have to start with the massive momentum in cloud AI, Neoverse dominance. This quarter, they announced a critical milestone. ARM Neoverse CPUs have now surpassed 1 billion cores deployed for complex AI and hyperscaler workloads.
1 billion cores. That's just a huge number of high-performance cores.
It is. But what's perhaps even more aggressive is their market share prediction. ARM expects its share of CPUs deployed by top hyperscalers to reach nearly 50% this year.
50%, wow. So they're projecting that almost half of the specialized cloud compute market will soon be powered by ARM. This is not incremental growth. This is a foundational shift in the data center.
It's a seismic shift.
So what are the biggest internal risks to achieving that 50% target? Is it a dependency on just a few big hyperscaler contracts? Or is it the difficulty of switching out those entrenched legacy by 86 architectures?
It's a bit of both, but primarily the latter has been the historical barrier. ARM is incredibly dependent on a handful of high-volume hyperscalers, NVIDIA, AWS, Google, Microsoft, who are all designing custom silicon based on Neoverse. So yes, if one of those four slows down their build-out, the 50% target becomes harder. However, the reason they are achieving this momentum is the overwhelming economic necessity of the switch. Legacy by 86 architecture is deeply entrenched, but it's fundamentally less efficient for cloud-native workloads and, crucially, for AI inference.
So it's really the economics that are forcing the change.
It is. The documents highlight that Neoverse CPUs are foundational for all the major players: NVIDIA Grace, AWS Graviton 4, Google Axion, and Microsoft Cobalt. These are all customized versions of ARM's architecture, which means ARM benefits from the licensing fees while the hyperscaler gets a chip precisely tuned for their cloud environment, cutting out unnecessary costs and power consumption.
Let's drill down into those specific use cases, because that's where the efficiency argument really shines. AWS Graviton 4, for instance, and their SageMaker AI platform are now running quantized small language model inference natively on ARM. What does that efficiency translate to for a company running workloads at the scale of AWS?
It translates directly into lower operating costs and a reduction in the total cost of ownership, or TCO. For these AI applications, performance per watt is the absolute key metric. If you can run those small language model inferences on an efficient ARM CPU, rather than constantly spinning up a massive, power-hungry GPU farm, the operational savings are just enormous. This is proving that the CPU, when designed correctly via Neoverse, is a central component for cost-effective generative AI inference.
And the examples from Google and Microsoft drive that TCO argument home even harder. Google has already migrated over 30,000 applications, including massive traffic drivers like YouTube and Gmail, to ARM infrastructure. And they plan to transition the majority of their 100,000 plus applications.
And the numbers Google cites are staggering. They really illustrate the economic incentive here. Their custom Axion chips deliver up to 65% better price performance and use up to 60% less energy than comparable cloud instances. When you operate 100,000 applications across millions of cores, those saving 60% less energy can save you billions in operational expenses and help meet ambitious sustainability goals. That is why the migration is happening so
It's
fast.
an economic imperative at that point.
It is. And similarly, Microsoft has expanded its Cobalt 100 deployments globally, now running in 29 regions. Hyperscalers are increasingly deploying ARM Neoverse CPUs as head nodes, the control and communication centers, alongside the big AI accelerators. This reinforces ARM's position not just as an accelerator, but as the new universal unit of compute in the AI data center.
And of course, we can't talk about AI without talking about NVIDIA. Demand for the ARM-based Grace Blackwell superchips remains exceptionally strong, with NVIDIA having secured expected orders over $500 billion through 2026. The sources also mention the addition of 5 new Stargate AI data center sites, all anchored on ARM as a strategic compute platform.
This is a crucial partnership. The Grace Blackwell superchip uses the ARM CPU, that's the Grace portion, to handle all the data preparation, control, and communication tasks for the massive Blackwell GPUs. It ensures the GPUs are fed data efficiently, preventing bottlenecks. This collaboration proves that even in the highest performance, most intensive AI training environments, ARM is central to the overall architecture. They aren't competing with the GPU, they are enabling it at scale.
Now, if the cloud is the foundation for AI training, then the edge and physical AI segments are really the explosive growth frontier for AI deployment. ARM seems essential here because these devices demand high performance, extreme energy efficiency, and low latency for local decision-making.
This is where that milliwatts to megawatts motto really applies. Look at the consumer edge. The Google Pixel 10 phone, which launched in Q2, is powered by the new ARM-based Tensor G5 chip. This chip runs the new Gemini model up to 2.6 times faster and twice as efficiently as prior generations. That isn't just marketing, that's the difference between waiting for a cloud server response and getting an instantaneous on-device AI result.
Then there's the developer edge, which I find fascinating. NVIDIA started shipping the ARM-based DGX Spark, which is basically a compact desktop supercomputer.
The DGX Spark is a signal that AI development is decentralizing. It brings capabilities like local model training, fine-tuning, and inference tasks that were usually reserved for massive data centers, directly to the desks of developers. This expands ARM's footprint beyond massive cloud farms into the actual development and testing pipeline, making the ARM architecture synonymous with AI development from the earliest stages.
And moving into the physical world automotive and robotics, the adoption is accelerating in high-value, high-safety segments. A flagship electric vehicle from a leading automaker launched this quarter, utilizing ARM Automotive enhanced technologies for things like intelligent park assist, multilingual voice control, and real-time safety systems.
But the most forward-looking example has to be Tesla. They introduced their next-generation AI5 chip designed for upcoming vehicles and robots, and it's based on ARM's compute platform. This chip delivers up to 40 times faster AI performance than the prior generation. Think about the complexity of running a fully autonomous driving stack or navigating a humanoid robot. These systems demand incredibly high, low-latency AI compute right where the decision is made. ARM's efficiency is enabling breakthroughs in vehicle autonomy and robotic scalability.
All of this hardware momentum and strategic innovation would just crumble without a strong software base, though. The sources highlight that the developer ecosystem strength is a powerful competitive advantage, uniting over 22 million developers. which is estimated to be more than 80% of the global developer total.
That ecosystem is a massive, self-perpetuating moat, and they are actively investing to make it even easier for developers to leverage ARM's efficiency. They launched an agentic AI integration with GitHub Copilot to help developers automate and optimize the migration of cloud workloads specifically to ARM infrastructure. So they're actively lowering the friction for enterprises still running on legacy systems to make the jump to Neoverse.
Sounds like they're not waiting for developers to switch. They're using AI to help them switch.
Exactly. And they're directly enhancing the core AI frameworks themselves. Their initiative, ARM-Kleidi AI, enhances frameworks like PyTorch, delivering up to 2.5 times faster performance on transformer-based models. And it boosts ExecuTorch, improving on-device AI speed and efficiency by over 20%. These tools are central to Meta's AI strategy, enabling faster AI response times across Meta's entire ecosystem of billions of devices. The strategic partnership with Meta spans everything from AI-enabled wearables to massive AI data centers, showcasing how ARM provides a consistent, unified software architecture from glasses to the cloud.
We've covered the explosive growth and the massive R&D commitment. Now let's look at the plumbing of the money, where it's flowing from, where it's going, and the structural risks the company's actively managing. Starting with the geographical breakdown, we saw a pretty standard distribution across the core markets. United States was about 374 million, the PRC was 250, Japan was 206, and Taiwan was 175.
Pretty balanced.
But the more complex story lies in the revenue derived from related party dynamics. This revenue, which comes primarily from ARM China and SoftBank Group affiliates, saw a massive surge. It increased by $230 million, or 120% year over year, to $422 million in Q2. That is 37% of their total revenue derived from related parties.
That is a huge concentration, and it introduces complexities. Let's focus on ARM China. The revenue from the Intellectual Property License Agreement, or IPLA, with ARM China was $243.1 million in Q2. Now, this relationship is a necessary commercial conduit. It gives ARM access to the absolutely crucial PRC market, which generates huge royalty streams.
But what's the risk?
The document highlights a specific dependency. ARM relies on ARM China to provide reliable and timely financial information so they can accurately determine the royalty payments that are due under that IPLA. If that flow of information were disrupted or delayed, it would introduce significant uncertainty into a quarter of their revenue stream. For any publicly traded company, having over a third of your revenue coming from related parties, especially one with known governance issues like ARM China has had in the past, requires very careful oversight by investors.
That makes the governance risk highly relevant for you, the listener, if you're tracking this stock. Beyond managing that relationship, the company is actively reshaping its portfolio through M&A and strategic transactions. On the divestiture side, it looks like they're focusing on high-value IP by getting rid of non-core assets.
That's right. They completed the sale of the Artisan Foundation IP business, this is stuff like standard cell libraries and memory compilers, to Cadence Design Systems in August 2025. This wasn't just housekeeping. It generated a significant pre-tax gain of $131 million. It clearly signals a strategic decision. Divest low-margin, commoditized IP to focus capital and resources entirely on the differentiated products, the CPUs, GPUs, and CSS that command premium royalties.
And they put that capital right back to work.
Immediately. In October 2025, which was a subsequent event to the quarter, ARM agreed to acquire DreamBig Semiconductor Inc. for approximately $265 million in cash. Acquisitions like this are geared toward accelerating their platform strategy and strengthening their core competence in high-performance compute design.
We should also touch on Ampere Computing. SoftBank Group expects to acquire Ampere Computing in the second half of 2025. And ARM, which held a minority shareholder position in Ampere, expects to receive about $140 million in gross proceeds for its equity interest. Again, capital is being rotated out of minority, non-core positions into core R&D or direct acquisitions like DreamBig.
And these strategic maneuvers are ultimately enabled by one of the most stunning financial indicators this quarter, the dramatic improvement in liquidity and cash generation. This is arguably the most critical financial health metric to look at.
Wait, let me repeat these numbers because they are massive. For the 6 months ended September 30, 2025, net cash provided by operating activities jumped to $899 million. We have to compare that to the same period last year, where they reported a negative $284 million.
A negative number last year.
A swing of nearly $1.2 billion in cash generation year over year. That's not just growth, that's a structural transformation of their balance sheet.
It is genuinely transformational. Non-GAAP free cash flow for Q2 was $411 million compared to a negative $65 million a year ago. Their trailing 12 months FCF more than doubled to over $1 billion, $1,073 million. This massive positive free cash flow provides ARM with immense financial flexibility.
So what does management say they're going to do with this unprecedented war chest immediately? I mean, this cash allows them to sustain that aggressive $720 million OPEX guidance, execute strategic cash acquisitions like Dreambig Semiconductor instantly, and navigate ongoing legal and geopolitical uncertainties, all without needing external financing. They have achieved complete financial self-sufficiency in driving their innovation strategy.
Precisely. They are funding their own R&D war in the AI talent market and buying strategic assets on their own dime. However, as strong as the financials are, we can't discuss global semiconductors without addressing the legal and geopolitical risks. On the legal front, the long-running, crucial dispute with Qualcomm over the Nuvia acquisition continues.
The sources mentioned that on September 30, 2025, Qualcomm was granted judgment as a matter of law regarding the Nuvia architecture license agreement breach claim. But ARM is appealing.
Yes, ARM has filed a notice of appeal with the Federal Court of Appeals for the Third Circuit. And this is a major dispute because it really challenges the sanctity and scope of ARM's core licensing agreements. If a customer can buy a company that has an ARM license and then fundamentally change the nature of the IP they are licensing without paying new fees, it devalues ARM's entire business model. By appealing, ARM is aggressively defending its IP structure.
And there's another lawsuit with Qualcomm now, too.
There is. More immediately, Qualcomm has a new, separate action alleging that ARM failed to satisfy delivery obligations under the original Qualcomm ALA. That case is currently expected to go to trial in the second calendar quarter of 2026. This ongoing litigation is critical because it involves huge players defining the fundamental rules of engagement in the chip design space.
And then there's the constant volatile movement of U.S. export controls, which directly impacts their significant revenue from the PRC. This is a very complex area of policy flux.
It's an area of constant adjustment. We saw several key developments this quarter. For example, the affiliates rule expansion, which would have broadened entity list restrictions to cover global subsidiaries of listed companies, was suspended for 1 year starting November 10, 2025. This provides temporary but crucial breathing room from heightened compliance complexity.
So some relief there, temporarily.
Temporarily. Separately, the AI diffusion rule, which imposed a worldwide license requirement on advanced computing, was rescinded in May, though the Bureau of Industry and Security, or BIS, is expected to issue a revised rule soon. This flux means ARM's regulatory environment is constantly shifting.
But what about the restrictions that remain in place? The documents emphasize that existing restrictions continue on gate-all-around field effect transistor, or GAEFET, and high-bandwidth memory HBM technologies to the PRC.
And those retained restrictions are the most impactful. GAEFET and HBM are foundational technologies for the most advanced AI accelerators and high-performance server CPUs, the exact products ARM is designing with Neoverse and Lumex. By restricting their export to the PRC, the U.S. is reinforcing its focus on protecting cutting-edge national security technology. This creates a difficult environment for ARM as they must ensure their most advanced IP, destined for the massive Chinese market, complies with these ever-evolving rules, which adds a layer of uncertainty to a major revenue stream.
That was an incredibly detailed survey, covering everything from specialized AI instructions to a major swing in operating cash flow. To ensure you walk away with the absolute most important insights, here are the 5 key financial and operational takeaways from ARM's Q2 FY2026 results. Let's start with number 1. AI everywhere drives premium royalties. The record royalty revenue of $620 million, up 21% year over year, is clear evidence that ARM has successfully shifted its model.
It is. This growth is directly linked to the rapid adoption of higher value, higher royalty architectures like ARM v9 and, crucially, the pre-integrated compute subsystems, or CSS. This really proves ARM's ability to drive greater value per chip, moving past mere volume and strengthening its core annuity business model.
Okay, takeaway number 2. Hyperscaler dominance is accelerating. The milestone of ARM Neoverse surpassing 1 billion cores deployed, coupled with that aggressive projection of capturing nearly 50% of the CPUs deployed by top hyperscalers this year, solidifies ARM as the undisputed most efficient unit of compute in the AI data center.
Absolutely. The efficiency gains highlighted by Google and Microsoft, up to 65% better price performance and 60% less energy, illustrate that ARM provides the necessary economic foundation for global-scale AI workloads.
Third takeaway, high-velocity innovation is fueled by high-risk investment. That 45% surge in R&D spending, hitting $466 million on a non-GAAP basis, signals a massive internal commitment to technological leadership in the AI race. We saw the results of that in platforms like Lumex CSS, which features 5x faster CPU AI performance.
But that dedication comes at a steep accounting cost. It heavily inflates the DAP operating expenses because of that required $265 million in share-based compensation needed to secure and retain top engineering talent globally.
Number 4. License momentum is strong, guaranteeing future annuities. Licensing revenues soared 56% year-over-year to $515 million, driven by high-value contracts.
And more importantly, that critical forward indicator, the annualized contract value or ACV, increased 28% to $1.6 billion, and CSS adoption reached 19 licenses. These metrics strongly indicate a robust and growing pipeline that will lay the essential foundation for recurring royalty streams for years to come.
And finally, the fifth takeaway. Robust cash generation provides strategic flexibility. Net cash provided by operating activities saw that dramatic structural swing to $899 million for the 6 months year-to-date, representing a shift of nearly $1.2 billion in financial health.
And that massive free cash flow generation ensures ARM has ample capital to fund aggressive R&D expansion, execute strategic acquisitions like Dreambig Semiconductor, and navigate the complex, high-stakes landscape of ongoing litigation and unpredictable geopolitical export control rules, all without any external financial strain.
So that's the picture, an incredibly strong quarter on all fronts.
It is. So we have a company at the absolute center of the AI revolution. It's achieving unprecedented scale in high-performance computing, epitomized by the Neoverse ecosystem, and that ambitious 50% hyperscaler market share goal. But simultaneously, we see them engaged in these aggressive legal battles, particularly the ongoing litigation with Qualcomm over architecture licensing. And this raises a critical question for every participant in the chip ecosystem. How will ARM balance its commitment to foster an open ecosystem, which relies on broad and easy accessibility to its IP, with the necessity of aggressively defending its core intellectual property rights against powerful partners in this new high-stakes AI landscape? That tension between openness and defense will really define the trajectory of ARM's profitability moving forward.
That is certainly a provocative thought. The high-stakes chess game being played over who owns the fundamental building blocks of AI compute. Thank you for joining us for this incredibly detailed deep dive into the Q2 results for ARM Holdings PISO. If you found this discussion valuable, please click like, share the video with your network, and subscribe to the channel for immediate access to future content. We deeply appreciate your support. And if you want to help ensure we can continue producing these high-quality, in-depth analyses, please evaluate becoming a channel member today. And don't forget that Super Thanks button is always there if you want to show your support directly. Stay tuned for upcoming content, and we'll catch you on the next deep dive.